Hello friends, you're welcome. Today we want to talk about cost theory. And this will be our outline. We'll look at the meaning of cost, types of cost, determinants of cost, cost function, short run cost theory, and the long run cost theory. So let's kickstart. Meaning of cost. Cost refers to the money expenses incurred by a firm in the production process. So basically that is cost. The money expenses are incurred by a firm in the production process. So costs are the total expenses incurred in assembling inputs, and you know the inputs of production. We have land, labor, capital, raw materials, you can add technology, entrepreneur, etc. in a production venture. So that is cost. But we have different types of cost. Let's look at them one after the other. So we have the actual cost, or also called the outlay cost, or the absolute cost, or the accounting cost. It is the cost or expenditure which a firm incurs for producing or acquiring a good or a service. So if you buy your raw materials, the cost incurred is the actual cost or the accounting cost. The next type is sunk cost. Sunk costs are retrospective cost. That is when you reflect when the past cost incurred that have been already incurred and cannot be recovered. That is sunk cost. And the next is historical cost. Historical cost is the price paid for a plant originally at the time of purchase. So how much you bought it at the time of purchase is the historical cost. And we have the replacement cost. Replacement cost is the price that would have to be paid currently for acquiring the same plant. So many times the replacement cost is higher than the historical cost. Now, if you are buying the same plant, how much are you paying for it? So the price at which you buy such a plant is the replacement cost. Then we have the transaction cost. Transaction cost is cost associated with the exchange of goods and services. So if you are exchanging a good or a service and you bought a transport, if all the cost you incur in the process of exchanging that good or service is transaction cost, including exchange rate. If you are to change your CD to dollar and you are losing some amount, all that are included in the transaction cost. Then we have controllable cost. Controllable costs are costs which can be controlled by the executive. So it's controllable by the executives. That is controllable cost. Then we have shutdown cost. Shutdown cost is cost incurred if the firm temporarily stops its operation. So shutdown cost is normally it can be saved by continuing your business, but the cost you incur in shutting down is your shutdown cost. Then we have economic cost. Economic costs are related to the future. They play a vital role in business decisions, as a cost considered in decision making are usually future costs. They are similar in nature to that of incremental, imputed, explicit, and opportunity cost. This economic cost is a cost considered by economists but not considered by accountants. Let me give you an example. Okay, so if you decide to buy if you decide to produce fan ice instead of fan yogo, and in producing fan yogo you get a profit of 20,000 Ghana cedis, and later you realize that if you decide to produce fan ice and fan yogo, and instead of fan yogo you produce fan ice instead of fan yogo, and in producing fan ice you get a profit of 20,000 100,000 Ghana cedis. Later you realize, oh, if you had produced Fan Yogo, your profit would have been 100,000 Ghana cedis. So the cost involved, the profit you didn't get from the production of Fan Yogo, but you decided to produce Fan Ice, is your economic cost. So it's quite indirect, and it is not really a tangible cost, but it is more or less like what you are losing as a result of you not producing that particular thing and producing something else. That is the economic cost. And we have the direct cost. Direct costs are costs that have direct relationship with the unit of production. So they can be easily and directly identified or attributed to a particular product, operation, or plant. So for example, the salary of a branch manager is a direct cost when the branch is a costing unit. Direct costs directly enter into the cost of production but retain their separate identity. But please note that these costs are not all isolated. Direct costs can fall into accounting costs as well. So just kindly note that. The next is indirect costs. Indirect costs are those costs whose source cannot be easily and definitely traced to a plant or product or process or department, such as electricity. Electricity, you cannot trace it to a particular department. It is used throughout the whole firm. Stationery and other office expenses, depreciation on building. The building is for the whole company, so you cannot trace it to a particular department. And decoration expenses, etc. And we have explicit cost. Explicit cost is cost actually paid by the firm. If the factors of production are hired or rented, then it is an explicit cost. How much did you pay for the capital? How much interest did you pay? How much rent did you pay? All these fall under explicit cost. And implicit costs, if the factors of production are owned by a firm, then its cost is implicit cost. Let me give an example. Assuming you are doing your own work, you are not paying yourself, so that is the implicit cost. Your efforts are not being paid, but if you had employed someone to do the same thing, you would have paid the person. So the payments that are not really done, but you are giving out something, your effort and others, is called the implicit cost. And then we have the social cost. Social cost is total cost incurred by the society on account of production of a good or service. So the cost the society bears in production, in producing a good or service, is the social cost. Alright, so we will end here and continue in the next we'll continue the others in the next slides.